Hey everyone, welcome to this week's episode of Charts of the Week with me, Markets and Mayhem. It is Sunday, March 24th, and we've got a fair amount of stuff to go over here. I think it'll be a pretty fun episode. Made a pretty extensive presentation for you all, so looking forward to going through everything. Just gonna, give it a moment here while we let the audience come by and join us. So we'll start off with the disclaimer slide. This is everyone's favorite slide because I talk a little more rapidly here. So there's a high degree of risk involved with trading and investing. Past results are not necessarily indicative of future results. MacroVisor and all individuals affiliated with the site assume no responsibilities for your trading and investment results. Coaching, indicators, strategies, columns, articles, and other features are for educational purposes only and should not be construed as investment advice. So now that we've got that out of the way, let's look around the world, and then we'll bring things more back home to the United States because there is a lot to discuss here. There are a lot of moving parts. There are some really interesting trends taking shape that I think could set up for some interesting investment opportunities. So I want to talk about all that. We'll start off first with Mexico. Mexico has been a long-term pick of ours at MacroVisor. We've been talking about the opportunity in this market really for about a year now, and it's played out quite well in the sense that Mexico is continuing to experience a bit of a manufacturing and economic renaissance. Now, some have attributed this all to mislabeling goods from China and redirecting them to the US and elsewhere. Sure, that might be a part of it, but that is a small part of the larger story, and we're going to dive into why. But first, I just want to give some high-level thoughts. If you think about it, Mexico is really just on the other side of the border from the United States. Of course, we keep hearing more and more about this for other reasons. But in terms of import-export, it doesn't get more ideal than sharing a common land mass. You take out all the delays and potential hiccups from shipping, all that interconnectivity, those appreciated costs, and then also, quite frankly, it's not that cheap to manufacture in China anymore. In fact, Mexico's 20% cheaper than China, which gives them a bit of an edge. So we're still bullish on Mexico at MacroVisor. We've been talking about it again for about a year as an opportunity. It's been an investment. It is a longer term investment. For us, it's going to be closer to a 5 or 10-year time horizon. But there have been swing trade opportunities along the way driven by momentum and relative strength. Now, Mexico's central bank has finally really started their cutting cycle now. This is the first cut we've seen since they stopped raising rates. And this is pretty important because this is the beginning of the Mexican reflation story. This is the beginning of stimulating even more domestic economic activity by reducing the cost of capital. But it's not just a domestic story. Foreign direct investment in manufacturing in Mexico has also been on the rise. And you can see it here in this chart. Iron and steel industry investment up 116% from 2018 to Q1 2023 versus 2013 to 2017. That's a pretty big jump. Base metal industries up 77%, right? Communication equipment up 44%, electronic power generation equipment up 34%, cars and trucks up 13%. These aren't just mislabeled Chinese goods. This is really other companies coming into Mexico because they want to build their goods closer to the United States without trade tensions at a lower cost with more direct connectivity and less room for bottlenecks. So you could reasonably say there are a lot of reasons for foreign companies to want to invest in Mexico to augment their manufacturing, their supply chain. And manufacturing is becoming a more important part of Mexico's GDP. We can see how it has risen here as a part of this nearshoring, as a part of this manufacturing renaissance, because Mexico's GDP is also growing. So we're seeing the GDP in the country grow, but we're also seeing manufacturing as a percentage of GDP grow. That's important. That's a change. As you can see on this chart, it pretty much flatlined until 2020. And if you look at Mexico, as I discussed a little bit from a geographic perspective, it's very close. In fact, there's over $100 billion of land-based trade every year that happens with Mexico. The vast minority is sea-based through the Gulf. What does that tell you? It tells you that's a very low disruption relationship, right? It's a lot easier for a ship coming from Asia to get disrupted on the way of the United States, or just supply chains on the other side of the world, than something that's right across the border. So that's another motivation for companies. Not only do they realize lower labor costs and in many ways a more favorable regulatory regime, but they also have less bottlenecks and less delays moving goods across the border. So that's the Mexico story in a nutshell. I wrote a thread about it. I'm still bullish of Mexico. I do think in the short run, for those swing traders out there listening, it might be a little overheated. But over the longer run, for you investors out there, I still think it's one that's worth allocating into, and I'm still dollar cost averaging into the EWW ETF as time goes on because I still believe the story here. Now, on the other side of the world, down under, Australia's economic growth is slowing. Now, Australia has a pretty tight relationship with China. I think that's important to take into context of what we're seeing on this chart, because one of the big reasons there's been a drop off in their GDP is that relationship isn't providing as much demand for Australian raw resource exports. Now, will that change as time goes on and the Chinese government attempts to stimulate their economy back into a more durable growth regime? Perhaps. But for now, some degree of caution warranted in Australia, in my own opinion. Moving over to Japan, one of the reasons the Bank of Japan felt comfortable departing the zero interest rate policy regime after more than 2 decades was wage growth. Wage growth has given Ueda confidence, as has inflation starting to come back, as has asset price performance. We're starting to see some signs of the Japanese economy recovering. Now, is it okay? Or is everything fine there? No, not by a long shot. Debt levels are still really high. They can't raise rates to anything resembling normalization because it would cause too much pressure for their government, but they're at least out of the NERP regime into the ZERP regime, from negative interest rate policy to zero interest rate policy. And there is still a growth story in the country. So we're still bullish on the Nikkei, but not quite as bullish as we were last year. Last year was a prolific trade in Japan. In fact, the trade setup for us was long Japan, short China. That offered 2 swing trades on the basis of relative strength in Japan and relative weakness in China versus the global equity indices. And so this year, we're a little more cautious on getting very bulled up on Japan. We're still optimistic. We're still bullish, just not as bullish. Just like with China, we're not as bearish. We closed those trades out. We're on the sidelines looking and investing in other opportunities. Now, we're going to just skip past that slide because I talked a little bit about that. We're going to go to the next slide here, which is tech leadership. Surging to all-time highs of tech versus the S&P, and this is after we've recategorized a lot more companies as no longer even being in technology, and yet it's still basically almost 2 standard deviations higher, right, than where this would normally be. In fact, exceeding that by this chart's measure. So that's a pretty decent sign that things are getting a little excited here. Now, on the one hand, there's real growth. Tech companies really have earnings this time, unlike in 1999. There's real growth here. So it's not just a bubble without any kind of reason. You don't just put .com on your name or AI in your name and your stock rallies. Well, wait a minute. On that last one with SoundHound and Big Bear AI, maybe it does. So there are some bubbly components to this market as companies marry themselves to AI. We see it with Reddit. Reddit claimed in their IPO filing that they have some tangential relationship with AI. Not much AI to be found on the platform, if we're being honest, other than, perhaps, their relationship to sell, to license the data, the content that people contribute to Reddit, to various AIs, including that of Google. So perhaps that's a part of that story. That's something to take into consideration, I imagine. But at the end of the day, I would say that we are getting really, really concentrated in tech. And I do think that in terms of risk and reward, there might be some other opportunities that are a little better there. And we're going to talk about those opportunities. I'm going to share them all with you. These are areas we've been covering at MacroVisor, and I want to keep you all up to date with the research we're doing there. So First, let's talk about crowding. The Mag 7 are back to over 30% of the S&P 500's market cap again. This is a level where I would get a little bit leery, particularly because it's not really the Mag 7 anymore, is it? Folks, let's look at what's really happened here. It's really the terrific two. Nvidia and Meta, they're the extraordinary performers. And the rest are not really giving the sort of performance that one would hope from a group called the Magnificent Seven, particularly Tesla and Apple, which are down year to date, and Alphabet, which is underperforming the S&P 500. Reasonable to say leadership in this part of the market is narrowing, and I think that is important. Now, when we look at short interest, even though the leadership in the Magnificent Seven turning to the Terrific Two is narrowing, what are we not seeing? We're not seeing really any interest in shorting the market. Now, I get it. It's been up and away. We've had, a really big surge in stock prices on some of the more popular stocks, although underneath the surface, there are still a lot of stocks that actually aren't doing so well. It's interesting to see a market making all-time highs in that context, and it is just a little bit of a cautionary note. You should see a significant improvement in breadth if the market is making all-time highs. We haven't quite seen that. Now, that doesn't mean it's not going to happen. It's an important area to watch to see if there is a broadening out or at least a rotation. But for now, we can see interest in SPY to short it is growing modestly, but no one wants to short the NASDAQ 100 or Triple Q. So that's interesting in the context of this next chart, because on the other side of the ledger, positioning in mega cap growth and tech is very extended. So that gives you a sense that it's not the worst it's ever been, right? It's not like what we saw in early 2021 before there was that bit of a rollover, but it's very crowded. It's a very, very crowded trade. So I would just be, again, looking at this from that perspective and saying, well, maybe it's a good place to consider taking some profits and redeploying them in other areas of the market that are more attractively valued and could have better risk reward. This is also a market where volatility is a thing of the past, whether we look at it at the VIX, whether we look at it in the MOVE index, which is coming down, that's the VIX of treasuries, so to speak, or even when we look at intraday realized volatility. It's all come down quite a bit. There's a lot of reasons for this. There are much more trades happening in shorter time horizons. There's obviously, 0 DTE, 1 DTE, all the way up to 4 DTE trades make up about 75% of S&P index options trading. That's act as a volatility compressor of late. So that's part of it. But it's also a market where it's pretty difficult to fight the flow for now, right? It's been basically a market that just goes higher. And in that type of an environment, there's not as much chop. Now, this is also an environment, speaking of sentiment, Bank of America does a fund manager survey and they ask, okay, well, what's your risk appetite right now? And right now we're seeing that bank managers, or fund managers, I should say, are taking the most risk that they have since November of 2021. It's not quite March 2021, but it's still really high. It is giving you a sense that things are just a little bit lopsided. And we see that in sentiment. We see that in flows. We've seen that in positioning in one of the prior charts on mega cap tech. It's pretty similar in other areas of positioning like NAAIM. And that just tells us things are just a little bit wobbly in the very crowded parts of the market. Now, that doesn't mean it's time to be bearish of everything. It means it's time to look for opportunities where the risk to reward is more favorable, in my own opinion. Now, when Goldman looks at data of the market being this stretched in terms of sentiment, what they've shown is that it often is the case that the next forward 2-week returns are a little bit more challenged, right? So it does amplify the risk that maybe there's a little bit of selling here, and we see some preliminary signs from asset managers. Asset managers and leverage funds have started to take down their positioning levels a bit. So that does suggest that at least in some corners of the market, folks are taking profits, and where are they? They're generally in the more crowded areas. We've also seen the biggest loosening in financial conditions that we have on this chart. This chart goes back, I think, to about 1996. So that's a pretty decent time period. It's almost 30 years. And we can see that during that time, financial conditions have not really loosened like this. This is pretty extraordinary. But what makes it more extraordinary is it's happening in the context of the Fed and they're doing one of their more aggressive tightening cycles, and yet financial conditions are loosening this much. There is a story here. Part of it is that this administration has done everything they can to fight the Fed. They've, for the first half of last year, essentially in a manufactured conflict, suspended debt issuance, which is net liquidity positive. And then in the second half of the year, really engaged in much more aggressive fiscal stimulus. That positive fiscal effect means the Treasury is spending more. It's on a deficit basis. That money winds up in bank reserves, and net, that offsets a lot of the impact of QT. I know folks like to look at the narrative of the bank term funding program was a new form of QT. I don't think that's really what the big driver here. I really believe it was the cessation of debt issuance that became liquidity positive, followed by the back half of the year with aggressive fiscal spend. Those were the bigger drivers. What the Fed did was they were able to stabilize the banking system so animal spirits could come back in the market. But in an environment of ample liquidity, that's where that trade really had legs. So just something to take into consideration, that it's not that we can ignore the Fed. It's that when fiscal and monetary don't agree, fiscal can prevail when it's reckless, late cycle spending. And that's the environment we're in now. And the Fed has been shrinking their balance sheet. You can see the little pop-up during the bank term funding program from last year, but now we're below that level, yet markets continue to march higher. So it's not a Fed liquidity story in terms of what's driving price discovery. It's a broader picture, and a lot of that has to do with, again, that spend by the government, the cessation of debt issuance for the first half of last year, but also countervailing effects from foreign central banks like the Bank of Japan, which even now that they've reached 0% interest rates, there's still a net additive of global liquidity into the financial system. So, the People's Bank of China, other central banks that are beginning to cut, there's that countervailing effect, right? So net, financial stress is really, really low. Now, that does begin to beg a different question, maybe one that's a little bit more important that's on our minds right now. What reason is there for the Fed to cut now? Right? That's something that probably deserves some more conversation, because my own opinion is it will be a policy mistake, and we'll talk a little bit more about that. But look at this chart. There is nary any significant financial stress anywhere, even in like the last year. Basically at this point, like we're now kind of rounding about a whole year of diminished financial stress, and yet we're talking about 2 or 3 cuts this year and maybe 1 or more next year. Now, I would say that is likely to be a bit of a miscalculation for the following reasons. One, if we look at the legal dual mandate of the Fed, it is maximum employment, which we could say with unemployment levels near record lows, and that's the data they look at, right? They're not looking at all these other measures like temp workers being fired and otherwise. They're really looking at unemployment as their primary compass, and it's near historic lows. Now, you could argue that one of the reasons it's near historic lows is so many filed for unemployment during COVID that they didn't re-up their insurance. They can't file now, or if they can, it won't last for very long. I'm sure that's part of the story, but the bigger story is it is still a relatively tight labor market overall. And so on the other side of it, there's the idea of price stability. Well, if inflation is beginning to show signs of reacceleration, we may not have that part of the Fed dual mandate on their side either. So then the reality sets in. Why would they really cut here? And my own opinion is it's to make it easier for the government to borrow and spend. It's purely along political lines. It's really about the sustainability of the government's ability to continue borrowing as much as they have, with interest spend set to make or exceed $1 trillion a year. QE becomes a very attractive relief valve, because when you're doing QE, the central bank buys debt from the Treasury pays interest to the central bank takes its expenses out of that interest payment, which are de minimis in comparison to the size of the total payment, and they give it back to the Treasury. So, when you get one of those like interest rate free credit cards, it's like that. And the Fed takes a small little nibble and pays it back to the Treasury. So that helps to alleviate that interest concern, right? But it's not a universal solution. A better solution would be for the government to get its spending under control. In fact, its spending right now, with unemployment as low as it is it's the largest deficit as a percentage of GDP that it's ever been, with unemployment as low as it is. So again, policy mistakes on the fiscal side, on the monetary side, could lead to some resurgence of inflation. We'll get to that in a moment. But first, let's talk about another measure of stress. U.S. investment grade corporate bond spreads. They're at lows we haven't seen since the first half of 2021, when it was an environment of buy everything that isn't nailed down or on fire. That's another sign that there's no reason for the Fed to cut. You can see what it looked like during COVID. You could see what it looked like during the great financial crisis. You could see what it looked like during some of the subsequent iterations of starting QE again after the great financial crisis. Each one of those spikes was met with a Fed policy response. There's nothing that looks anything like that now. In fact, even bank reserves are rising as deposits increase after last year's debacle. So even there, I know there's some regionals that are under stress. I know there's a issue with office building loans in certain regions, and maybe 100, 200 regional banks that are exposed to that it could be problematic for. But I also know the Fed has the programs at their disposal to foam the runway for those banks, like the Bank Term Funding Facility or funding program. They can foam the runway. They don't need to adjust their entire policy framework for a couple hundred regional banks, especially when all signs are banks are lending again, right? And you can see it in consumer loans. You can see it in commercial real estate loans. Where's the stress? I'd really love to know, because I keep getting told that there's some imminent commercial real estate apocalypse that's going to kill us all. And I don't see it. I see pockets of problems in regions under stress. San Francisco, New York, Chicago, Dallas, all these downtown areas with high office vacancy rates. Sure. Is that going to bring down JP Morgan or Citigroup? No, it's not. It's going to have impact on smaller banks. It's not going to be pretty, but it's not a giant financial crisis that's going to rip the world apart. I feel like people are getting a little ahead of themselves on the CRE thing as a reason for the Fed to cut. And I don't see that as being the primary impetus here. Now, what I do see is global growth is rebounding. We see that, and that is one of the reasons to be a little bit more concerned about a reacceleration of inflation, right? And it's not just growth that's rebounding, it's also price PMIs. So we look at S&P Global Flash US PMI price indices, and we can see input prices and output prices are starting to bottom and perk up. That's a bit of a concern. If one is thinking that the immaculate disinflation story will continue unabated, Bloomberg Macro says maybe not so much. We are seeing global disinflation begin to peter out here. And Bank of America contends that it may even be set to reaccelerate. They're looking for month-over-month core CPI to trend up to 3.6 or 4% by June, which would be a legitimate reacceleration of inflationary pressure, and that would be a departure away from what the Fed wanted to see. Remember, Powell did say back in December he wants 6 months of constructive inflation data. Now, at the last meeting, he kind of put that to the side and said, well, what we saw over the last 2 months was more bumpiness. But you can only say that. You can only say there's some unexpected turbulence for so long. If the data really starts to point in the other direction, that does create an issue for that narrative that, everything's under control. We've got it all situated. No worries. I would be a little bit more concerned that this Fed does not have everything under control. They're buckling to political pressure to monetize the U.S. debt, something that Ben Bernanke famously said they don't do, right? I think this was like 16 years ago. He was in front of Congress, and he said the Fed's job is not to monetize the government's debt, and they don't do that. Well, you could have fooled me, because they've been the biggest buyer at auctions when they were doing QE. So pretty much it seems like, and I just explained how QE helps to essentially alleviate interest burden. So it would point in the direction of actually, no, the Fed is directly monetizing the debt. And that's the key pivotal reason, really the only reason for them to come back and start cutting. And we see from Bloomberg again, that there are expectations that PCE, which we'll be getting out this Friday, could also show signs of reaccelerating following CPI, right? Now, PCE is the Fed's favorite flavor of inflation, as it were. So if they do see that in PCE and particularly core, which is what's shown on screen here, PCE X food and energy, that will be a concern as well. That could slow their roll. That could undermine their cutting. So let's talk about some opportunities. We've got the picture painted with the financial conditions around the world are easy. Inflation's showing some signs of reaccelerating. Tech is very concentrated. What looks good in this environment? First of all, I'm very interested in what happens with natural gas in April. Now, I don't want to buy the commodity itself. It is a widowmaker, and it's called that for a reason. But in April, 75% of the time from 2004 to 2023, or 20 years of seasonality data, it's up by an average of 4.5%. So for natural gas producers, I'm interested. I like companies like FANG, F-A-N-G. I think that's an opportunity to get long natural gas in a really well-run company. So that's one play I'm considering for my portfolio as a swing. The other area I like investing in this year are dividend stocks. They had a bad year last year. But if the Fed is going to cut, these should become more attractive to people that are trying to produce income. So I think there are going to be some opportunities in dividend stocks. And those are some of the things we've been sharing at MacroVisor, some of our picks and dividends. I also have a whole bunch of other opportunities that are part of this sort of re-acceleration of inflation trade, right? These could be good swing trades or even investments if this becomes a more secular regime. Energy, industrials, materials, aerospace and defense, utilities, global copper miners, and key emerging markets like India, Vietnam, the Philippines, and Mexico all seem attractive. Let's go through them one by one. Energy, because we are still in an environment where demand is likely to exceed supply, because we're still in an environment where the price of energy is providing a lot of these companies nice, comfortable margins where they can actually continue to grow, where they can continue to invest and even begin to expand production in cases where they have that slack, that flexibility. The other thing I like about energy is we need a lot more than we have right now, a lot more. There's this idea that we're going to power the whole world with all this growing need for AI, for building out of infrastructure, for reshoring manufacturing. All this is going to require energy, and it's not just going to be, energy as we may want it to be. Like there's this idea that we can just build solar panels and wind farms and everything will come out of that. And it's unfortunately not scalable to that extent. Solar cannot scale. It's weather dependent. It's intermittent. It relies on battery technology that's largely weather dependent as well. And wind is weather dependent. And so you have these large periods where there's intermittent interruptions in that, which means you need natural gas fired plants. You may need some coal. You need augmentation. If we could ever figure out nuclear waste, we would need more nuclear as well. But it seems like the West can't really figure that situation out. So it leaves us with hydrocarbons. It means there's opportunities in natural gas, in oil and gas services, and even in some of the better run coal companies. And as time goes on, maybe if we open our minds and we figure out the waste disposal situation, there'll be better opportunities in nuclear. And if solar does get more efficient, don't count me out on that. If we get panels of 30 or 40% efficiency, that means they're capturing that much photovoltaic energy and converting it into electricity. It becomes a more attractive value proposition. But for now, I'm not as enthusiastic about it. We like Enphase. We've been bullish on that. It's been a winner, but we're not mega bullish on solar. We're looking more at the broader energy space. Industrials, materials, those are also late cycle plays. And if we're reaccelerating this economy and we're seeing it overheat and we're seeing inflation come back to some degree, industrials and materials tend to do quite well in that environment. Aerospace and defense, because this is still a world full of geopolitical tension and risk. So, being long, whether it's some of the smaller ones, we really liked SAIC, it just pulled back. I look at that as an opportunity where I want to buy more of that company. If you zoom out its chart, you'll see why. You don't really fight against it. But even looking at some of the bigger ones like Raytheon and Lockheed look attractive. I'll skip Boeing for obvious reasons. Utilities also look attractive because energy consumption in the US, for example, is set to almost double over the next 10 years. This has everything to do with new data centers, AI, manufacturing, all this coming online. And that is not something where we have the generative or transmission capacity for it yet. That'll be bullish for utilities over the long run as they're able to grow revenues and likely bottom line earnings as well. Global copper miners are a part of the story as well. If we need to grow our energy transmission, if we're building new infrastructure, if more parts of the world are also getting wired up for the first time in some of these frontier markets, that means more copper, and we've seen it break out of a very big trading range, and the miners are following along, if not leading. So we're bullish there. We're also bullish on India, Vietnam, Philippines, and Mexico. You can find the article I wrote about Vietnam on my feed. And that pretty much wraps it up. So if you'd like to learn more about our work, subscribe to Macrovisor. You can visit us at macrovisor.com. You can follow us on Twitter, Mayhem for Markets, and Aisha Tarek. And look out for our Q2 2024 outlook that'll be coming soon. Thanks everyone for tuning in. I'll catch you soon.